evening, traders. Welcome to BCR's Market Wrap-Up, where you break down the key moments shaping the financial markets. Let's take a closer look at what's driving the dollar index, crude oil, and gold. First up, we have US dollar index. The market's initial reaction to Powell's speech was a slight dip in risk assets, reflecting a reduced likelihood of a near-term rate cut. This response was broadly in line with the expectations. Still, markets had been pricing in a 40% chance of a cut in May and a 31 basis point reduction by June, indicating continued anticipation of a dovish shift from the Fed. That shift, however, did not come through. Powell largely used the speech to delay firm commitments and maintain flexibility. In the Q&A session, Powell suggested that Trump's policy direction would soon become clear, an assumption that may prove overly optimistic. If re-elected, Trump is expected to retain the ability to impose or threaten tariffs throughout his term, contributing to ongoing policy uncertainty. While markets are looking for clearer signals to support investment decisions, a well-defined policy framework is unlikely to emerge soon. Now coming on to crude oil. Oil prices have been under great pressure in the past 2 days, and on Thursday, Brent crude oil suffered the largest sell-off since August 2022. The reciprocal tariffs are higher than expected, which has raised demand concerns. The addition of OPEC Plus maintaining its plan to increase production in May will only exacerbate such concerns. The demand situation has deteriorated this year, and given the impact of tariff increases on global growth, demand may be further adjusted downward. At present, we expect global oil demand growth to be 1 million barrels per day, with risks tilted to the downside. Lastly, we have gold. Gold retreated from record highs this week following the announcement of US tariffs. We believe this may reflect 1. Investors unwinding long gold positions to uncover equity margin calls following the continued broad sell-off in equities, and 2. Investors may be shifting gold to alternative assets now that uncertainty related to reciprocal tariffs has been initially resolved. However, we believe that the potential decline in gold is an opportunity for investors to go long. And gold remains our most firmly bullish commodity. Not only do we see continued structural support for prices from EM central bank buying, but we also see increased ETF demand further, supporting prices on the back of Fed rate cuts and recession fears. While current speculative net long positions in gold may decline from very high levels, we maintain our forecast of $3,300 for gold by the end of the year and maintain our forecast range of $3,250 to $3,520, which mainly reflects the upside risks to investor positioning. We continue to believe that there is still upside risk to our price forecast. As always, I would like to say stay safe and good luck with your trades.